Good afternoon. Welcome everybody to another edition of Market Sundays. All right, we got a jam-packed show today, and I'm technically on time, depending on whose time we count. Right, so we got a bunch of things that I want to talk about. Of course, we have to discuss the Paramount Netflix battle and how that turned out, and my thoughts behind who won, who lost, etc. Things like that. I want to cover, of course, as we continue to move into the future. We talk about areas of AI that's taken over. And we talked about the agents, which I think is probably going to be a big deal. Could be wrong, but we'll see. And I also want to discuss something that my brother sent to me. He sent me this company, and he didn't necessarily say anything. He just sent it. We got a chat. He just sent it, and I looked at it, and I had some thoughts behind it. So I want to share that with you guys as well, right? So hope everybody's having a phenomenal weekend as Sunday starts to conclude that and we move into Monday. All right. I've had a pretty busy weekend, a lot of fun reading. I know we love to read. And I've been chilling, man. I've been chilling, but I'm in a good mood. So I hope you guys are doing well, right? So first thing we're going to start with is this company called PlayersTV. I'd never heard of it before. I didn't know anything about it. So I have a natural resistance to things like that. Just natural. Well, what's that? That's new. Not because I reject innovation or live in the past, but just because I have just natural cautionary views on things, especially when it comes to making investments and things like that. And a lot of these companies are unproven. Okay. They're just unproven. And I would say most investments people make usually don't turn out well. You're normally lenient on one or two investments doing extremely well to cover your losses for other attempts. So when you're dealing with like angel investors, when you're dealing with venture capitalists, people like that, they invest in a lot of different things, and a lot of those things don't necessarily go well. They don't necessarily produce money. They don't necessarily turn out well, but they're typically an assessed risk that those people are willing to take. And so as we get on lower ends where we have less capital and we're still trying to build up our capital base, we have to be a little bit more picky with the investments we decide to take, because we're typically in more of a make or break situation. Okay, that's just simplest there. Okay. Hey, Miss Doris, how you doing? And so because of that, I think it's important that when there are opportunities that we scrutinize them the right way and we understand what we're getting into, right? So this company called PlayersTV. I don't know if any of you guys have heard of this. If you have, please let me know. But it's the first time that I was even had it go across my eyes or anything. So, I looked into it briefly. And of course, I started doing some research just to try to get a better understanding of what this is and what this not. And typically that starts with a generic search just to see. The reason why I do a generic search is because I want to see how much information there is about the company, right? Is there a lot of information? Is it very little? It kind of gives me a baseline on the impact that this company has or has not had. Then, of course, I look for the leader of the company, the CEO, the people that's running it. Try to do a little bit of back searching on them, get a little understanding of their background, what they do, what they've done well, and see if it makes sense, if they're aligned with the type of business and industry that they're in, all those things. And then, of course, I start to back check and I start to check websites and things like that. So I went and I found an interview from the people that run the company, CEOs, whatever you want to call them. And there were a lot of alarming things about the interview for me that naturally I just was kind of rejective of. I was just like, yeah, no, I don't really like that. So I'm not going to play the interview. I'm not going to do it. Okay. But I will show you the image of the people that are in particular running that particular company. Okay. I will show you the image of it. And that's about it. And I'll get into why, right? So everybody knows I like people that run my company to be wearing glasses. I like people that look like they locked in. You know what I'm saying? Like, oh, okay, this person, they absolutely look like they not about to do nothing but just eat, sleep, and breathe the business. Now I got these two people here, gentleman in the middle, and then the gentleman to his left. I don't see no glasses in sight. Now that's a problem for me. Now I know what you guys are saying. Oh, you can't be so judgmental. Yes, you can. When you're dealing with your capital, it's your alarms that you set off and go, yeah, probably not. Appearances matter, especially if you're going to make public appearances in order to influence or garner momentum and things like that. So you got both of these gentlemen. Now, part of the disturbing factor is both of these gentlemen have their hands crossed like this. I don't know why, if that was strategic or not, but I don't like it. Don't like it. Don't no ties on. They both got mugs in front of them. I don't think either of them is drinking coffee. So that's all of that is like the whole interview. I don't see neither of them take a sip or anything. So I don't like that either. That threw me off. Okay. That threw me off. But I went on and listened to a little bit of the interview and things, of course, that I already know exist. They go on to sell themselves, talk about their upbringing, try to humanize themselves to the viewer, which unfortunately plays on our natural behaviors as humans, right? We look for connect pieces. We look for ways we can feel someone is like us because we kind of buy from people that we like. So, no matter what, we like this person, we kind of tend to want to buy into them. So I just listened to over that interview. I will drop the interview link in the chat if any of you actually want to listen to that interview. It's totally up to you, but that's part of some of the research I was just doing, just in a generic place, just a quick assessment of what's going on, right? After that, I decided to check out the website, right? Now, guys, this is important. When you're going into any type of potential investment or any potential strategy of why you should do something, why you shouldn't do it, you have to understand, one, your risk tolerance, two, your understanding of the business, all right? Now, I want to say, in a general sense, this is a media business. It's called PlayersTV. Essentially, they have athletes and things like that, and they kind of talk about celebrity lifestyle and, things like that. Stuff, in my opinion, that we kind of already have access to, but they're insinuating there's a deeper access to this and whatnot. So I'm going to go over the website, right? The website tells you a lot. So for a lot of the companies we talk about, they have investor relations page. I've talked to y'all about this before. Y'all can type in any company, Apple, type in Apple's investor relations, Google investor relations, whatever you want. Any company you can think of, any major company, you just type in investor relations next to them, and that will generate their investor relations page, right? And on there, it will have typically their most up-to-date quarters on their financials. It will typically talk about their strategies, partnerships, all kind of stuff. It will give you a general baseline. Of course, you have to dive in and do your own deeper thing, right? And so I went on this company's website, right? And we're going to go over it together, right? Because I just want to look at a few things. We'll look at them together, right? So we'll go over that website. All right, shout out to everybody that's in the door. Hey, Crystal, how you doing? Unc is in the building. What's good? But we're going to look over the website, and we're going to talk about some of the things that stick out and why you may or may not want to take a risk with certain investments based upon presentation, based upon your understanding, right? This is important stuff, like it or not, right? So first things first, we have here, this is a website. Here, I'm going to go completely. Let me see if I can just pull up their whole. Yeah, I'm just going to pull them up on the screen, right? This is the website. It's called PlayersTV. It has a bunch of investors on there. Part of those investors, that, as indicated there, it talks about Travis Kelce, Dwayne Wade, Kyrie Irving, Chris Paul. There's Vernon Davis. I remember he played for the 49ers, and he might have played for another team. I can't actually remember what other team it was, but I done seen a couple commercials with Vernon Davis, and I'm not a big fan of his commercials. I'm just telling you that now, right? So I'm looking at the website. It's big, bold, and all that stuff. And it places emphasis on names. Like, for example, it says become a shareholder alongside Chris Paul, Dwayne Wade, and 50 plus other pro athletes, right? Now, some of the things that threw me off here just looking at it. Number one, I'm looking at the capital raise, 6.4 million. 6.4 million for capital raise. It's 50 plus total athletes. The indication that so far the number of investors is about 2,200. The minimum requirement is about $1,000, right? And they're valuing the company, however they got to this valuation, you can make this argument, at about $5 a share, right? So simple math will tell you this. If you're spending, i.e. $1,000, right? Because that's the minimum investment requirement, at about $5 a share, you're getting about 200 shares, give or take, right? Cool. Fair enough. 200 shares in this pro company, right? Or pro athlete company, right? And as we're looking at it, look what it says right there. It says, join us to make history. Join us to make history. No. I'm not. We're not trying to make history. We're trying to have strategic placement of capital to get an ROI on our investment. We don't care nothing about trying to make history. I don't care if this is an old TV company from way back in the day. Do it make money? And is it going to make me money in the future? History making, that's a whole nother story, right? So I continue to look this over. Mind you guys, for the people that's just coming in, this company was sent to me in a group chat. And I like to do research and things like that. That's just what I like to do. And I simplify it as much as I can just for my own life because I don't want to spend too much time on these companies, right? And so I peruse their website. As you guys can see me, we're doing that live. Scrolling down and I'm noticing, okay, they're showing all of the athletes, right? Part of that, what is that? Marketing, right? Kind of selling to you these athletes. These athletes are selling influencing, right? This is influencership to me. Is my opinion, right? They're showing Ken Griffey Jr., Dame, Kyrie. And they're showing a lot of prominent athletes. We got Carmelo here. We got a lot of prominent athletes that are showing as part of the 50 plus professional investors, right? So that's scrolling down the timesheet. All of them, nice pictures and all, right? Very nice pictures. You know, we continue to scroll down. They talk a little bit about the numbers, right? We're looking at the numbers. It's saying estimated global sports media market size by 2028 is about 75 billion. So it's a $75 billion possible market that we would be able to have competition in, or that may be available, right? So that's the TAM, right? Total addressable market, etc., right? 75 billion. Okay, cool. Nice numbers, right? Also indicates about 30% annual growth in the athlete-driven audience engagement. So their wholesale is that these athletes are really good at generating audience engagements. Whoop-de-doo. We kind of already know that that's true. Okay, people kind of look up to athletes. Cool. To talk about projected sports podcast revenue by 2027 is $1 billion plus. All right. And then it says 28% expected increase in athlete-driven content and by advertising by 2026. So they're saying if athletes are driving this content, there's by 2026, which we're in now, potentially you're looking at about 28% increase there, right? With athlete-driven type content, right? So we continue to scroll down. They talk about their premium distribution partners, right? So as you can see, scroll down, you see a few names pop up here, prominent names. In my opinion, these would be competitors, right? These would be people in some form competing with them, right? But you can partner with competing people, I guess. That's totally fine. And so I'm looking at these names and I'm looking at the website, how it's displayed, and I'm like, so interesting, right? So I continue to peruse, right? Because we don't like to do anything lazy. Okay. Boy, they got a lot of pictures of athletes on here, don't they? All right. Here it says attraction, full 360 media distribution ecosystem. Okay. 300 million available homes and devices. What does that mean? 300 million available homes and devices. Are y'all telling us that that is the potential group that we can access, about 300 million plus homes? Okay. Now they're saying available monthly advertising impressions about 200 million. Now, we would have to do an excessive amount of research to find out what does that actually mean when it says available monthly advertising impression. We don't believe that you're making 200 million. So the way that's displays is the potential of what you could do, right? That's how it's easily noticeable here, right? We don't believe that they're generating $200 million and they want to talk to us. That's just my opinion. Right now, says 250 million total aggregate athletes social media following, right? So based off of all their investors, they accumulate 250 million plus social media following. So if Dwayne Wade got 13 million followers here or 5 million on TikTok, they're accumulating all that and they're saying it's 250 million plus, which in my opinion, with 50 athletes, Kyrie Irving, 250 million should be much higher, in my opinion. Okay. And they're producing so-called originally produced series featuring over 30 athletes, right? So they're producing lifestyle of athletes and things like that. It's supposed to be very unique, right? Whoop-de-doo, right? That's the indication there, okay? So I keep scrolling down, just looking it over, and I noticed that a lot of the marketing is, a lot of indication of the athletes that is involved. And it says they've raised $6.4 million. Now, I could scrutinize that even more. I just have no desire to scrutinize that even more, right? I'm just looking at the website, and it talks about some of the brands that they work with. A lot of these brands are the same brands that athletes work with or probably have deals with, okay? So I'm scrolling through all of that. Whoop-de-doo. And I'm just looking around. I'm looking all through the site and all the good stuff, looking at the co-founders and what they talk. And I'm just watching, going through. And at the end of the day, I'm not going to lie to you. I'm not impressed. And I'm going to tell you why. All I care about is where it says they've raised $6.4 million. Why is this problematic? Well, let me tell you. With all those athletes that they have listed there should be no need to come to regular people to try to acquire $1,000. I want you guys to pay attention to this. When is the last time you've seen people that are wealthier than you come to you about making an investment that was going to help you? Aren't they normally trying to sell you something or getting you to buy their stuff so they can become richer and richer? Why the desire to allow regular, everyday, common folk to be involved? I mean, think about this. The minimum investment is $1,000. That's how much the minimum investment is, guys. $1,000. Now, to me, that's already a red flag. In my opinion, when you see things like this, when you're dealing with athletes that are generating tons and tons of money, they've only raised roughly about 6.4 million, which essentially is nothing. One athlete could give them $10 million. I'm sure they blow that a year. So that's concerning for me too. Why are you going the pathway of trying to make regular everyday people a part of the future? And my guess is this. This is my guess. You don't have a lot of SEC scrutinization here. So they don't have to follow a lot of those particular laws. Well, they do have to follow laws, but let's just say they don't have to release certain data and certain information on financials on their company if they're not going on the IPO on the stock exchange. And now I'm not saying that that is the pathway to go every time. Why do we always have to go their way? Because if they start talking about these people this and why we got to do it their way, to me that's another red flag. If there's already a pathway and already in a way which business is already done, and then you're trying to skirt it, we've heard this before. We've heard people say this all the time, and it's a little concerning for me. But the way I look at it is this. There are tons of companies that if they thought this was a good idea, if they thought this was a huge return on their investment, they wouldn't allow you to invest for $1,000. First of all, $1,000 is not going to help y'all. I don't care what anybody's going to do. $1,000 is not going to change your life. And the amount of time it would take for this to happen, it ain't gonna be that impactful. You would have to spend a lot of money in order to get an actual return. So that's already red flags. All the marketing around these athletes, more red flags, right? So when you see stuff like this, where you see people are not, one, they're having trouble. I'm going to repeat this, guys. There are tons of venture capitalists that are already doling out tons and tons of money for ideas that they don't know is going to be successful or not. And they deal out in the millions, hundreds of millions, and billion, all kind of money. How much money do you think they would be able to get from regular everyday people? A lot. Because it's the same way money is extracted from regular everyday people at your Walmart, your Target. Like, there's no real recourse to situations like this. They're going to tell you, hey, outcome, investments are not guaranteed, because most likely this is a losing business. Because if this was a good business, one, they're competing in a heavy space, right? If it was a good business, they wouldn't need us. When Nas was doing his deals, and look into Nas, man, he's been making some phenomenal investments and things like that. They didn't come to the people and say, hey, you can invest in this company. They ain't trying to share no equity with us. Listen, when you believe in something that's going to be hugely successful, you limit equity. You do not try to give up equity. You try to hold as much equity as you possibly can. And if even worse, now maybe they're trying to use this deal as maybe, hey, a loan of your money that you ain't going to get back, in my opinion. So when you look at stuff like this, just get away from it. Unless you just want to experience this for just fun, or you I'm just want to see how this play out. This just looks like fun to me, or, I just want to get a little bit of the process. If you just want to give away $1,000, there are a lot of other ways you can do it, but if this makes you feel better, fine. But I would personally, I'd be like, you know what? No, won't you go ahead to go on the New York Stock Exchange like everybody else, and I'll buy shares from that regulated site where a lot of other people and a lot of other things have been put in place, a lot of what we call guardrails and a lot of regulation in place, so that people can't skirt around a lot of these rules, right? And this is one way that people go around it. I just don't believe they're gonna give y'all access to these mind-blowing companies. Wouldn't y'all like to be contacted early on for companies like Apple and Microsoft and YouTube? Wouldn't y'all like to be like, oh, they never offered us that? Yeah. So we know this is not gonna happen. So this is just little stuff that happened to me over time. People send me stuff in the group chat, and if I have time, I look it over. Just my thoughts on that, guys. You may buy what you want. You might buy whatever you want and do it however you need. We will support you, but me, myself, no. Absolutely not, okay? Not going to happen. Now, let's jump into, let me see here. Where we at? I want to jump into real quick the Meta and the AMD chip deal. Just real quick. I just want to cover that real quick, because it kind of touches on a few things that I talk about a lot. One, first of all, we have incentive to discuss Meta, right? Because there's a incentive to the success of Meta for me in particular. So I like to stay up on a lot of stuff that they're doing, right? So Meta, they completed a deal last week with AMD. AMD is similar to NVIDIA. They're like the number 2 player in the market, fighting for the number 1 spot. I think they have phenomenal products. They generate a good amount of money. Their stock has been doing extremely well the last few years. I think they're second only to NVIDIA. So it kind of tells you a lot. They're not as talked about as NVIDIA is because NVIDIA is the bigger name, the bigger player, but they are the number 2 player in the field. And remember, I told you, realistically, top 3. It's all different ways you can make money, and you don't have to be the number 1 spot. It's ideal to get the number 1 winner, but all of these companies are going to generate money at somehow, some way. You just got to find a way to get involved and get a little bit of it. Just go ahead and get a little bit. But I just want to go over this deal real quick.
As we've discussed, this major chip deal between Meta and AMD today making waves, but it's following an increasingly similar playbook. Deirdre Bosa tells us why in today's Tech Check. Deirdre.
Hey, good morning, Sarah. So the market rewarded this deal with a 7% pop, but the terms are worth a closer look because what's inside is becoming the standard playbook across the chip industry. Now, as part of the deal, AMD is giving Meta warrants to buy up to 10% of AMD for a penny a share, conditional on AMD stock hitting warrants to buy up to 10% of AMD for a penny a share, conditional on AMD stock hitting $600. That's
okay. Let's stop right there. So when you're talking about these warrants, right? It gives you the ability to exercise them or not, right? And we're talking about 10% of the company, which is insanity, right? I don't even know if that's reported right. 10% of the company is insane. Did she really say buy up to 10% of it? Let me go back and make sure I heard that right. That's a lot of percent. Hold on.
Playbook across the chip industry. Now, as part of the deal, AMD is giving Meta warrants to buy up to 10% of AMD for a penny a share, conditional on AMD stock hitting $600. That's right.
Okay. So just what she said. KG was good. So 10%. Okay, cool. And you're going to be able to buy them at a penny a share. Contingency, they get to $600 a share. Now, that's not unbelievable. That particular industry, along with NVIDIA, is the hot spot. It is what is driving everything. They are the engine that kind of starts everything, and gets everything going in that chip industry. It's in video games, computers. So like these data centers, all these build outs, all of them are going to need these chips. And Meta's buying a lot of them. Google's buying a lot of them. So you got AMD and NVIDIA, which are the dominant players in those industries, right? And in this indication, this is basically a shares based compensation for AMD and Meta. So Meta is like, okay, we'll buy your chips. One, this is kind of crazy, but in a lot of ways, AMD is saying, hey, look, we'll pay you to buy our chips. As crazy as it sounds, if AMD is giving 10% of their company, or at least stock warrants, to acquire 10% of the company, and in return, Meta agrees to buy their chips, it's kind of like AMD paying Meta to buy their chips, depending on how you look at that, right? Now, it is a win for both if Meta's spending the money, right? Because one, that's going to drive bottom line revenue for AMD to share to their investors. They have basically guaranteed contracts, money being produced. We have big name company like Meta that generates a ton of money that is going to be able to continue to produce income for us on our bottom line that we share with our investors. This also may allow other companies to say that's a total good deal. Like maybe somebody else will get involved. If Meta, who is a phenomenally run company, on the always got their fingers in when it comes to being on the top end of success. I'm not going to say ingenuity and all that kind of stuff because in my opinion, it's not necessarily the case because they usually acquire a lot of companies and maximize them, with their strategic abilities. That's not necessarily innovation, right? So, but they are typically at the top of those outcomes, right? And that might influence another company to invest. That might influence another company. Say if Meta's doing it and Meta's our competitor, we can't let them have the best stuff. We need to have the best stuff to compete. So it has a domino effect there, right? But essentially, that's what you're seeing happen. You're seeing AMD. Now, in my opinion, there's two ways to look at that. One, either NVIDIA is so dominant that AMD is having trouble acquiring business partners, and so they have to incentivize you to utilize their product, or AMD is in such strong belief that their product is so good that they're willing to pay you because they know you're going to want more of it. They're going to give you that. They're going to give you a taste of this business, and they're going to say you're going to come back for more. That's all I can really think of in the short term. Now, it's a strategic strategy to say, look, I don't need to be better than NVIDIA. I just need to get their customers, and I'm willing to do more. NVIDIA might feel like, oh, we have a superior product, so we don't have to give similar deals and things like that. So it just depends. It just totally depends on how you view that, right? But the way I'm going to interpret it is this. AMD is the number 2 spot. They obviously have a product that is generating revenue. They obviously have a product that people are using. So, but it may be the inferior product. I don't know if it is or not, but when you're having to pay somebody essentially to patronize your business, it's very different than from the demand just being so high that people are willing to pay whatever. Now, mind you, Meta has inked deals with everybody. Meta's, that CapEx is crazy. I know. They've been spending money like crazy. Everybody, Amazon, everybody's spending like $100+ billion on this stuff. So it is what it is. But the money has to go somewhere at the end of the day. So as they always say, follow the money, right? So I just wanted you guys just to kind of look at how that's playing out.
So Meta has a direct financial incentive to keep buying AMD chips because the more they buy, the more likely those warrants pay off. Now, AMD did nearly identical terms with OpenAI back in October. So that is potentially 20% of the company under warrant to win 2 customers. Our David Faber.
So that is essentially the same deal that OpenAI got. Now, OpenAI has a lot of momentum. They are widely considered the dominant player in the space that they occupy. And Meta has enough power and influence to demand the exact same deal that OpenAI. Now, another way to look at it is to look at it like this. Maybe they're incentivizing those companies because remember, when there's a shared goal, the odds of your success tend to be higher because as a famous person said, you can own 100% of nothing. So AMD like, look, partner with us. Hey, you partner with us and we're going to go to the moon together. So maybe aligning yourself with the right people will have shared desires on a mutually beneficial outcome. That's probably the way to look at it.
Pressed AMD CEO Lisa Su on this 3 times earlier today, and she just said it was a win-win, once-in-a-generation opportunity. But think about what this means. AMD is essentially paying its biggest customers to buy its chips. Now, customer acquisition dressed up as a semi-deal. We saw something similar today at a smaller level from.
So that's just might be how you might want to look at that. I'm just going to interpret the way I see it as strategy. We'll see who ultimately wins. I don't think NVIDIA's lead is substantially as far as it was. I think AMD is making ground on them, but I think it gets harder. Remember, it's harder to keep pushing up and up and up and up. I just think it gets harder and harder, and it doesn't become easier to do, in my opinion. So I'm looking at that strategy, and I'm just follow it. I'm gonna follow their strategy, see if it goes well, if it goes bad. We'll just continue to see how it plays out. Ultimately, I don't have any. I don't have. There will be no impact to me as far as NVIDIA and AMD because I'm not. Yeah, I don't have a substantial positions in either of them. Every time I think about it, it's like, it ain't the right time because look, I'm looking for the deal that's advantageous for me. a lot of different industries make money. And if you buy wrong because you make a horrible decision, it hurts. It hurts a lot. So sometimes you have to remain disciplined. And if the opportunity is not there, you got to stay away. If everything isn't adding up to what you need to do to basically make an action on an investment like that, you just got to sit it out. And sometimes you're gonna watch it go to the moon. You just got to sit back and watch, because one thing I will tell you is there will always be opportunity in the future. They always say it's a once in a lifetime thing. That's been it's once in a lifetime. No, we keep seeing it. It may be just with that company, but there are going to be tons and tons of opportunity in the future. As Warren Buffett once said, believe in America, invest in America. So, as I said last show, some of these older people are quite wise. Some of these older people are quite wise. Now, let me I want to jump into the AI agents for a reason. We talked about them a little bit last show, but we didn't go too in depth. But I just want to continue. Give me 1 second. Give me 1 second. Okay, there we go. It said something with my audio, so I just want to make sure everything is fine. So let me get this screen back up. There we go. So I just want to continue to just kind of highlight it, just because we don't exactly know where every successful industry is and what will be and what not. We got to take some stabs at it and see if we get a little bit of luck, a little bit of genius, a little bit of intelligence, a little bit of strategy where you're like, oh yeah, I saw that coming. And when we speak about these agents, I think they're kind of important. And the reason why I think they're important is because it allows a level of basically automation. Similar to how we see in these cars operate, we are also seeing other areas. And I'm interested in them primarily because when it comes to consumer behaviors, one of the things I know that works really, really well is when people don't have to think about it. When people are like, oh, I don't really want to think about it. So when something's automated, when something's automatic and you don't have to think about it, people kind of like that stuff. And these agents have the ability to automate a lot of people's lives and make decisions. And there's no pain receptors going off. Similar to like the credit card process, when you use a credit card versus cash, the pain receptors in your mind react differently, right? When you're paying with cash, there's pain receptors going off in your head like, I just spent $50. Ooh, I just spent $200. Ooh, I just spent $500. When you have a credit card, your mind doesn't register the cash the same because it's a credit card. So it's swipe. And so that's why there's a lot of push for people to have digital products, right? There's a strong push for that because it combats the human behavior that we naturally have to protect ourselves and things like that, or stay conscious and aware of things, right? Because if we feel a certain way when it comes to making a decision, we might not make it. And they want to remove our ability to have any doubt or remove any friction when it comes to transactional things. So you may have noticed, like I'll give you a simple one that you guys will agree with. It is really, really easy to put your money in the bank. Boy, do they make it hard for you to take out. You go to that bank and say, hey, I got 50,000 cash. Can I deposit? They go, absolutely, no problem. Run that money through the machine. Sure. Hand you a receipt. Have a wonderful day. You go back in 2 months later. Oh man, you know what? I think I need that 50,000. You walk into the same bank, seeing the same person that helped you out. Hey, can I get about 50,000? Oh, Mr. Smith, you want that in cash? Yeah, I want that cash. Remember, I was here 2 months ago. I gave you the cash. I just need that back. It's in my account. It's my money. Oh yeah, Mr. Smith, we actually don't have that much cash available to give you. But how y'all don't have it? I gave it to y'all 2 months ago. Y'all, you remember me? That's true. I do. But how it works is we actually just don't carry that much anymore. I'm happy to give you a cashier check, right? And y'all all heard that similar line. It's the friction for transactions, right? The fluidity of it. They don't want you to use the cash. They want you to use digital products because your mind is going to respond differently. Very similar, right? Now, me understanding that people head hurts when they're required to do their own finances, when they're required to do their own thinking. People do not want to do it. I'm not going to sit there and think people are going to wake up one day and decide to do it themselves. So in my mind, these agents may be just what the mass people are going to be utilizing in the future. I see Amazon putting some R&D into this in the sense of they're kind of figuring out how they can retain their data control of their website and without outsourcing that skill and giving it back to another company. They want to retain that and make it in-home. So they're already looking at producing their own agents for their own sites and things like that. And if Amazon gets any good at it, then they're going to start selling it to other companies, which ultimately I do believe that they have the capacity to be great, because I think Amazon, top to bottom, in my opinion, the best run company in the world. It's just how I see it right now. Because of that, I understand y'all might be participating with this agents because y'all like to do things without y'all having to feel a certain way. So I pay very close attention. Salesforce is one of the dominant players in this field. Visa is working on agents, all these things. Of course, Visa, because they're in the payment industry, right? And so I'm paying attention. These are billions and billions of corporations that are putting some investment in this. Now, by the way, companies invest into things that they do not utilize for a long time. However, they do retain the knowledge that they acquire during that process. So they may not actually bring that product to market, but it may have been the starting point for a different type of product, right? Because they had this experience, they may go on to produce a different product that they learned in that development of the product that they scrapped and didn't utilize. Anybody that works for a major company knows what I'm talking about. They've had products or they've had test runs on things and they go, oh, we're not going to go live with that. We're not going to do that. They test in certain markets. I have been part of what they call pilot groups where they test certain things before they nationally roll it out to the greater company, et cetera, and things like that. And I've seen things go well and they say, oh, we're going to scrap it. So a lot of you work for big companies. You guys know exactly what I'm talking about. So let's get into the conversation.
An agentic AI inflection point. Got that? Agentic AI inflection point. That's what NVIDIA's CEO is calling it. But what on earth does that mean? And could it reset the tech leaderboard? Let's bring in Deirdre Bosa with today's Tech Check to shine a light more on this. Deirdre, welcome.
Kelly, it already is changing that leaderboard. So what Jensen Huang is saying essentially is that the race at large has changed. We are now in the agent era, and that means a different cast of characters, different cast of winners, different tools. Take a look at this chart posted by Andreessen Horowitz partner Olivia Moore. She used Yipit data that tracks new premium subscriptions across the major AI platforms. OpenAI dominated the chatbot era, no surprise, peaking at nearly 1.7 million new subs a month early last year. But that growth this year has been stalling right at that inflection point Huang is talking about.
Now, I want you guys to look at this. You see ChatGPT, you see Perplexity, you see Gemini, and you see Claude. Claude is from Anthropic, and they are really ramping up the pressure on OpenAI, aka ChatGPT, depending on how you view it. They are a big deal. They are a big deal. There's some complexities in the business just because how they're running it, and they have this back and forth battle with the government contracts that they have and the restrictions that they have on their company. And so, but pay very close attention to them because they are a big deal. Perplexity is a big deal. Gemini is a big deal. They're obviously owned by Google. So, but you notice there's a level of stagnation when it reaches a certain amount of users. And part of that is the friction between willing payers for a product and the other product that is free. So most people are using the free product, right? This is a premium subscription, meaning people are actually paying, right? This is actually generating revenue for these companies, right? So the number would be insanely higher for just overall subscriptions. This is the premium one where there's the actual cost to utilize this product. And typically the premium comes with upgrades or more access or more tools or something to that degree. But I think the mass of people, they are going to use the free product. And the company does not mind giving you free product because they're getting data in return. Remember, data is like, I don't know, whatever gold is to a lot of people, like the real money, like that's what data truly is to these companies at the end of the day. So that's what you're noticing when it comes to this. Okay, so you're starting to see the premium pay, the scale where it's capping at. You're starting to see the rise of competitors. You're starting to see OpenAI's lead starts to dwindle a little bit. But I want you to pay very close attention to what industries are most impacted by this.
Meanwhile, Claude has been steadily climbing. Now, this all matters because OpenAI built its lead answering questions, but the competition has now shifted to agents, and that is AI that runs tasks, operates software, executes entire workflows. The latest releases reflect that. OpenAI shipped Codex, a full coding agent. Anthropic's Claude Code hit $1 billion run rate in just 6 months. And yesterday, Perplexity jumped back into this race with an autonomous agent called Computer that can take one prompt and run with it for hours across multiple models. So in this light, Kelly, it's also interesting to look at Google in that chart I showed you. Gemini, yes, it got a big bump when it launched its latest model, Gemini 3, but it faded fast, arguably because it was still a better chatbot in a market that is moving past.
All right, so guys, what are we looking at? This is where AI agents are getting to work right now. What industry is getting impacted the most? I want you to look at this so you can kind of get a baseline of where the impacts are strongest at, right? This is how we kind of get a grasp of where the market is heading, where industries are the most impacted, things like that, right? So if you look at the bottom, the ones that are least impacted are legal. So that means anything in the legal industry, okay? It's hard to disrupt them currently, okay? They don't even have 1% of disruption, right? The next thing, customer service, very little impact there, right? Which obviously we know why. It's kind of hard to integrate the AI agents in place of customer service. It's a little bit harder there, right? And for many reasons, right? And as you continue to scale up, you see cybersecurity, you see finance and accounting, you see sales, marketing, automation at 9%. But at the very, very top, you see where they're experiencing the most impact is in software engineering. So ultimately, that's where a lot of the impact is, right? So you see the opportunity. You have to see what they can do in those areas and then how they can scale that, etc. But right now, you see where the most impact is happening, and that's in software engineering. Pay very, very close attention to where impacts are happening, because then you kind of know what area you need to get involved with as far as an investor, probably as far as business, and as far as someone that is in the marketplace to sell your skills in return for a healthy income, okay?
Chatbots. It didn't have, or at least it didn't properly demonstrate the agent capabilities, which are developer tools, deep integrations that are becoming the hallmark of this new race. Now, for investors, it suggests that even a great model launch, it's not enough if you're winning the wrong war. And right now, this is anybody's race to win. I don't know if you got to read it, Kelly, Howard Marks' new note that was out today, and he talks about thinking it was a bubble, late last year to using Claude and just being.
So overall, what's happening right now is there's this whole belief in SaaS companies, and there's a whole belief that there's a bubble going on there. So you're seeing a lot of pressure on these industries. Salesforce is a major one where you see heavy pressure on the stock, and its performance has not been great. They did recently, I think, announce like a $50 billion buyback or something like that. So that's in the short term push the stock up, because obviously that's a return of capital to shareholders. That's going to pull back a lot of shares on the open market. And the less shares on the open market, the more valuable is the share you own, which will increase your EPS, which is earning per share, etc. It'll make a lot of things look better on paper. It's essentially a bump without a tax impact, right? So a lot of buybacks are done because it usually doesn't trigger any taxable situation, but it makes the value of the asset that you own even better. So that's why you start to see that now. Keep close attention on that. Salesforce is a very interesting company. I know they're going to be making a lot of money, so they're one of the leaders in that space, right? So those are just a couple of things I wanted to cover before we got to the important conversation, to the real thing, the real deal, Holyfield, right? Which is ultimately Netflix, Paramount. The battle is over. The battle between Netflix and Paramount is over. All right. I'm going to give you my thoughts on it in the short term, what I expect to do, and just my thoughts around it, how it went, what I think will happen in the future, et cetera, et cetera. Just different ways to look at it. Man, oh man, oh man. All right, so let me move this out of my way. Move this out of my way. Actually, hold on. Before we get to the Netflix, before we get to the Netflix, my bad. I don't want to jump out of order. I have a order plan that I was going to do it, and I don't want to forget. I want to talk a little bit about Anthropic. Before we even jump into Netflix, let's get to Anthropic, guys. And there's a reason for it. There's a strong reason why I want to talk about Anthropic first, mainly because one, this huge battle that they have with our government when it pertains to allowing their technology to be utilized, as we're trying to compete with other countries who have no red tape in front of them. Who, like, I've seen this one video, and they had machines performing military acts. And they were insanely impressive, jumping over things at full speed. I was like, yeah, it's getting realer and realer. And I was like, dang, how do we continue to compete with that with a lot of red tape around? And Anthropic is a huge player in this industry, in this field. For a lot of who don't know, Anthropic is the one of the major competitors to OpenAI. The founders of Anthropic are former OpenAI employees or used to work for the company, executives, however you want to consider them, right? And they didn't like how OpenAI was going through a certain process, and they wanted more restrictions, more control, because they see the dangers of what AI can ultimately become. And that's how they went on to produce Anthropic, which has been doing insanely well, especially with their product Claude, and a lot of people are actually enjoying it, right? So I just want to jump into a video from them real quick. Let me pull them up.
Well, software stocks are back to getting hit today, down about 2%, but investors are no longer selling indiscriminately. They are beginning to separate the winners from the losers. For today's Tech Check, our Deirdre Bosa has more on how the market's drawing that line. Hey, Dee.
Hey, good morning, Carl. So the companies that got crushed, they're now lining up to partner with Anthropic, and the market is rewarding whoever takes the deal. Thomson Reuters jumped 14% the day it announced its partnership. Salesforce popped 5%. Figma even credited Anthropic in its earnings beat. The playbook is starting to look the same for these companies. Anthropic shows that it can replace you first, then second, offers to work with you instead. If you say yes, your stock recovers.
I just want you to listen to what she just said. Anthropic shows you that, hey, if we build a competitor to your company, we essentially can phase you out. Let us show you. Build it up, simulate everything, and show you like, oh yeah. And then they say, but if you partner with us, we won't do that. We won't even think about bothering you. Just partner with us, make sure you can put some money in our pockets, and we leave you alone. It reminds me of, do y'all remember those brothers? Okay, there's this group of brothers that go around and they duplicate business models. They did it with eBay in Europe. They did with a couple other companies. They created a competitor, and then they got bought out. And then they do it. That's all that they do. They literally design competitors similar, basically the same model. I can't remember their name right on the top of my head. And then they make the company buy them out. And they've gone on to do this plenty of times, and it's pretty interesting to watch it. That's essentially what you heard them say Anthropic is doing. And then in return, if you get down and lay down, then what you'll see is your stock will be rewarded. At least that's what's happening now. So they're identifying Anthropic as a new kingmaker, meaning if I touch your stock, it's gold. Similar to how it was when anybody said NVIDIA. Y'all remember when anybody was like, oh, yeah, they said NVIDIA or they said AI, the stock will go through the roof. That's how I was going.
Now, it is a remarkable amount of power for one company to have. Anthropic is essentially deciding which legacy companies get to survive the transition and which don't. For investors, the question isn't really even about software anymore. It's more simple. Is your company useful to the AI, or is it replaceable by it? Here's the skeptic's case, though. These companies, they're betting that if they plug into the AI, they stay essential or they even level up. But what if they're just handing over their most valuable asset, their data, and making themselves easier to cut out later? Right now, Anthropic needs Salesforce data to make its agents useful. It also needs Intuit's tax logic to do your books. But those are also training opportunities. Once the AI understands how your pipeline works, it may not need the middleman at all. And we've seen this movie before with Amazon and retailers.
So basically what you're saying is once this technology gets a hold of your company and its business model, it's trained itself on how to duplicate it, reproduce it, and to effectively make a better run business with your current business model. And knows exactly your little, they call it the secret formula, right? Proprietary data, proprietary technology, proprietary, however they want to call it, in which they use to operate their company. I'll use a short similar idea. It's the Coca-Cola thought, like with their recipe. They don't share with nobody. Not one group knows exactly what the formula is. They piece by piece through different departments. You guys do this, you guys do that, you guys do this, you guys do that. And then after they push all those different layers, then they get it all in one and have everything, and then they produce it and send it out. They are not letting one group just do it all because they need to protect that formula, right? And so what they're saying is Intuit has a formula, but once they get into your system, and remember, it's like machine learning. They're supposed to retrain themselves on how to do something better and identify mistakes, issues, all those things. So imagine if you allow this technology into your company, filter it through your filtration system, and then it masters your whatever strategy that you use that most people didn't know you were doing, and it masters it, and it can reproduce it possibly in a greater way. Man, that's crazy.
One more thing, guys. OpenAI just closed $110 billion in fresh funding this morning, yet both Amazon and NVIDIA, two of the biggest backers in this round, they're down, or we'll call it flat today. The market kind of just shrugged it off. But remember, not long ago, OpenAI was the lab that moved markets. Now Anthropic ships a blog post and stocks swoon. That kind of tells you everything about who is wearing the crown right now.
So essentially they're a little fed up with NVIDIA and OpenAI and them, and they're like, yeah, you guys are at the top, but all y'all growth might be behind y'all. These other companies can grow at 500%, you know, and that might be more worth it to me and stuff, et cetera, things like that. And so that's why you see Anthropic, if they touch your business, it's gold right now, while OpenAI, even though they're closing funding, it don't hit the same way when you say we got an OpenAI deal. So you're starting to see a switch of the guards, and NVIDIA has to combat them. NVIDIA has to make their investors believe, hey, we still got this. Don't worry, we still got it. Or Anthropic will potentially take the lead.
That's interesting, Deirdre. Going back to the Anthropic partnerships, is this something, when they're partnering, is it something where the software companies are paying a bunch of money to work with Anthropic? Is it just a kind of a mutually beneficial partnership that we're seeing, given just, as you mentioned, the hordes of data that they can provide, which would be beneficial to Anthropic, maybe even more so than a dollar value?
Right. It feels like a lot of these deals are kind of meant to get the headline out there. Like Anthropic, how can Anthropic kill us if we're working with them, right? We're just basically powering up with what everyone sees as the greatest AI company at the moment. So what I've seen is kind of like do the deal, get the headline out there, then maybe figure out the details a little later. In the case of Figma, and I spoke to CEO Dylan Field, that was a really interesting integration because Anthropic was already using Figma as part of their tool shop. So that maybe explains why the market liked this as well. But I think that going forward, it's unclear. Yeah, maybe you want to get some money from Anthropic for helping in training, but then again, that kind of gives them the case to and the ability to cut out these companies later. So each one is a little different, but I think the point is that software CEOs want to signal to the market that they're working with these great companies that are so disruptive because we haven't figured out exactly how disruptive they are yet.
Speaking of disruption, Dee, I wonder if you can give us a sense out west as to how people are thinking or talking about Dorsey and Block, if this is sort of a warming up of what Musk did at X. And
now this is just a random reference to Dorsey at Block, and Jack Dorsey is the CEO of Square, known as Block. Now they changed their name, etc. He used to run Twitter, all that good stuff. And he essentially is laying off 40% of his staff. The stock shot up after he did that, which when stuff like that occurs, that you set up you set up a potential industry standard, right? If you lay off 40% of your staff and your stock shoot up, then possibly a PayPal or another company that's in similar industry or is in the same industry can do a same action and get that stock pop. So you'll start to see the trickle effect where me doing well makes my competitors do well because we trade similarly. So like on just a regular day, if Verizon stock is going up, then AT&T, T-Mobile stock is going up, whether it's minimal or whatever the case, it carries industries with them. If it goes down, then they carry the rest of them down. You see that happen a lot. That's why they talk about this sector is down, this sector is down. One company may have said absolutely nothing, but the other company said something. And because they have so many similarities, they're kind of tied to each other on a day-to-day base like that. So that's what you're kind of hearing.
in terms of headcount, or if this is sort of eccentric and off to the side.
I will tell you that people out here have sort of seen this from Dorsey before. They're being pretty hard on him, and they're saying that he's sort of like the king of bloated workforces. So this is convenient for him to cut his workforce in nearly half. So, you know, they see this as a Dorsey thing and not necessarily a trend that could take over others. Personally, I think it's really interesting that Block, I mean, sure, it's not growing as much as it was in the heyday, but this is a company that is profitable and it is still growing. And this isn't the kind of AI washing that you've seen over the last few years. Maybe you think, okay, this company needs to cut and AI is a convenient excuse. This feels a little different. It feels a little more of a harking back to that Citrini note where they said that these companies.
Yeah, when it comes to the payment industry, that's one of the reasons why I took my shares at PayPal, took my little small winnings and dipped. Just because the payment industry is so crowded, and you know, it's so hard to predict the winners in that industry consistently. I know people use Venmo. I know some people use PayPal, and I know people like to share costs and when they go out and hey, split the bill and all that kind of stuff. And I know they've made it more seamless and things like that. But it's just so complicated, the payment industry, how consumers spend their money and technology that they use to spend it. It changes so frequent. You can be like, it could be a thing, payment processing. So like Square was a big thing. You can just go any restaurant, they have Square set up, tap it, whatever. But because there's so many competitors in that space, somebody can undercut you. One of the companies I like in the payment space, what's the name of that dang company? Don't you hate when like you got all these dang names in your head and you're like, God dang, I think they just upped their valuation. So there's forget it. I'm not gonna lie, I can't remember the name of it on the top of my head right now. But anyway, there's another. I believe it might be a Dutch company, but either way. Oh, Stripe. There it is. Stripe is another payment company that I like that I've been keeping my eye on for a while. That they're growing their volumes year over year at very high rates. But at some point, it's like it's a payment company. You know what can make you superior to another payment company? And right now, that's not the clearest picture. So that's why I kind of I'm staring away from that, even though their prices are so like depressed. Like you can get these companies like on crazy sales, right? If they're able to execute going in the future, etc. But I don't know if they can. And just laying people off only stops the capital bleeding that happens when you're paying your employees, but it doesn't necessarily return enough income back because you're not producing anything from that product. So we'll see. All right. Now let's get back to where we need to go, which is the Netflix and Paramount battle. So for those of you who don't know, Paramount has won the bidding war for Warner Brothers. I've been telling people in this industry, the media industry, when it comes to the IP and the assets that Warner Brothers have, it's pretty good. I mean, they got a lot of companies that they're in control of, right? Just what if you go on their website, you could you can see a few of them pop up right there. You got obviously DC. You got Game of Thrones, you got Harry Potter, you got Looney Tunes, Scooby-Doo, Tom and Jerry, just to name a few. Mortal Kombat is something that I think about. I love Mortal Kombat. I love those movies. I love the game. It's just something that hits with me. I'm like, yeah. Somebody's like, hey, you want to go watch this Mortal? I'd be like, I don't really go to the movies, but I might be willing to go for that. What, that new Mortal Kombat? Yeah, we going. So there are a lot more to mention. I can't even think of. I don't even know my friends or whatever. It's a lot of content. It's a huge library that they control. I want to talk about the pluses and the minuses of that, of my viewpoint on that, about the deal, the winning bid, etc. And I'm going to get into that in just a moment, all right? Robert Platinum says Paramount's pockets were too deep for Netflix to win the bidding war. Well, we'll have a conversation about that in a moment. I just want to pull up Tom Rogers because he knows a lot about the media industry, and he kind of talks a little bit about how he views the outcome of the Paramount battle over Warner Brothers with Netflix. Okay, so we're going to listen to that, but then we're going to deep dive, then we're going to share our thoughts on that, right?
Like a Peace Guy, that's higher in the after-hour session because it got what it needed. Netflix shareholders like Tim breathing a sigh of relief here. Netflix shares popping in the after hours, a bigger spend debt-free, right, on content here. Buyback, Tom?
I've been wrong before. I haven't been wrong on live TV like that before. That explains why the stock is much higher, though. The market got it right.
You got the news just wasn't out yet. None of us had seen it. No. So I mean, the direction on the stock is fascinating. What's interesting is that both companies win here, and that's fascinating. This also comes on within the last 24 hours. We've gotten earnings out of Warner Brothers. We've got earnings out of Paramount. Paramount's TV business looks okay. I mean, in other words, that's the profitable part of that business. And so
what they're indicating here is, remind you, Paramount is technically owned by Skydance. Skydance bought Paramount 6-7 months ago, towards like the end of August or something like that. And now they're acquiring Warner Brothers 6-7 months after acquiring that company. Obviously, the guy heading it and everything is the son of Larry Ellison, who is the top 5 richest man in all of the goddamn world, especially in America. But we tend to think America is the world where we're in our little bubble, right? And so he's been in acquisition mode, and he's still acquiring. But they're saying for Paramount, their TV business is not as bad as everybody else's TV business. Everybody else's TV business is a lot worse than theirs, and theirs is actually performing well enough to sustain, at least currently. So everybody else is not doing well. So that's an interesting point. At the bottom, you see Netflix is saying it's going to put another $20 billion on content, and instead of the money that they were going to dish out here, they're going to put it in their own content developed. So that's interesting enough. Okay.
this is a fascinating time in media. I think some of the parts really says it goes higher.
The problematic part here for Paramount is now 80% of the EBITDA of a combined Warner Paramount is going to come from cable networks. And with Warner's earnings just announced today, their cable networks declined in EBITDA by 27% in the fourth quarter. And that looks like it's accelerating because it was 21% for the year over year, 24 to 25. That means that Paramount, with all the leverage it's going to have and it declines in 80% of its business, has a lot of work to do. And that's a very different model, I must say, with my Versant hat on than Versant, with very little debt and a lot of capacity to be able to invest in the growth of these great franchises like CNBC. Stark contrast there.
Julia's got some more details here. Julia?
Yeah, I just want to note, Melissa, that as part of the deal that Paramount Skydance has offered, they will be paying Netflix's termination fee. So originally, it would have been Warner Brothers Discovery would be required to pay $2.8 billion to Netflix to terminate the merger. But as part of its increased offer, going from $30 to $31 per share, Paramount also said, and in addition to increasing our offer, we will also pay that $2.8 billion to Netflix. So Warner Brothers no longer has to pay that. There's another termination fee.
Now, listen to that. So what that means is this: when companies are getting acquired and they go into confidential talks, right? And they're binding talks, meaning you can't be telling other people, hey, we're doing this, or we're aligned to this. This is confidential in binding talks. And so after, and this is what happened, Warner Bros. Looking to sell themselves, basically. Netflix, they didn't go around searching for Warner Brothers. Warner Brothers found them and said, hey, we're thinking about a sale. What you think? Netflix picked up the phone. You said what? You said what? I mean, if it's the right deal, we'll take it. If it's the right deal, I want you guys to understand this. Netflix, Warner Brothers business was suffering, and it's suffering really bad, right? And it's trenched in debt, as it was part of the AT&T spinoff. I had owned AT&T at the time, but I took, like, I'm very good at taking my fuse and dipping. I'm gonna just tell y'all that now. I'm not too greedy, right? So when I see something that's not going around, I'm like, yeah, let me get up out of here. Take my fuse. I don't care if it's $10 in the positive, y'all. I'll take my fuse and dip it, right? So because one of the reasons that I liked AT&T at the time is because they were acquiring it. Now they were obviously, well, that's the whole Warner Media and all that. They did a lot they did a lot of name changes as when they acquire companies that they do, but that was one of the selling points, because I'm looking at all of the IP and all of the assets that Warner Brothers had. I'm like, okay, this is good. Okay, maybe AT&T can find a way to make this accretive, right? In a sense of over time adding to that revenue increase, right? Because at some point your income starts to stall and your growth stalls very bad, and you're running out of ways, right? So I'll dive deeper on that in a second. So Warner Brothers businesses was not going well. They even merged, they even bought Discovery, merged them together, put the debt on them and spun them off. So they had a whole strategic strategy on how to get the debt off AT&T, the primary business, right? That's why AT&T is doing much better. If you go back and check when the stock was trading like $7, $9, whatever the case is, it's doing much better now because a lot of that debt was rolled over into Warner Brothers, which caused a lot of downward pressure on the stock and the potential to be well. But what you'll find is that even though the stock was trading at $7 or $8, and if you look at the market capitalization at the time, it's nowhere near what it is now. And so if you look at what they're buying the company for versus how much debt, it's so interesting. Like, just when you look at how someone views assets versus to how much the company itself is actually producing, it can be really mind-blowing, right? Because had Netflix never went into this agreement to buy them, the stock would be $7 or $8 or worse. Because that's just how bad the company has just been ran into the ground. The debt on them is just being worse and worse, right? So now So now you have where they're currently at now, selling themselves to Paramount. Obviously, Paramount probably had their eyes on it, but they couldn't really talk about it. And I'm sure when Netflix and them were invited, other industries knew, because what you have to realize, 3 things you should pay attention to when you're dealing with a company, right? I don't want to get too far like going off task here, but I just want you to understand this. Companies have boards. People that sit on those boards sit on multiple boards, right? So you may sit on the Disney board, and then you also may sit on the Nike board. You may sit on both of those boards and may sit on another board of another completely different company. You might be on AT&T, Disney's board. So if you on that board of one company and you know you're in pursuit to purchase another company, and when you go to your other company that you sit on the board, I know they follow the rules. So it's not like they'll tell, hey, we are in talks to purchase such. It's not like they do that. They follow the rules. But the point being is, pay attention to the board every chance that you get. When you're looking at the company, look at the board of directors for a reason. See where else that they sit on the board, because you'll see a lot of deals be made amongst one another. A short way of looking at this is looking at how Elon just put his XAI company and tied it directly to SpaceX and made them buy it. And it's like they just do little stuff like that. But anyway, after Warner Brothers was selling themselves off, because basically they're selling themselves for pieces, because they realized we're not running the company well enough. We have to get the best return for our assets, and we need to sell ourselves out and get up out of here. And they did. I want to tell you all this. The shareholders of Warner Brothers should be extremely happy about how they were able to sell this off, because this was just a dying business. Even with all those assets, it just wasn't working. So they done a phenomenal job to take this Netflix deal to the Paramount payment that exists now. Just want to because the stock was getting so bad, I was looking at it like $7-8. I'm looking at it like, I kind of see where this might could go, but I don't want to make an investment on a potential takeover, right? That's really a bad idea to invest in a company based on the fact that they are a takeover ready, right? Because that's not a great investment theory yet. But why you think this stock will do well? Well, they going to get taken over by another company. Well, that's not the best way to make a decision. So I didn't want to do that, but I foresaw that was a high probability, right? Now, obviously not to this degree. Now, as we're watching this play out, you have Warner Brothers selling themselves to Netflix, basically. Netflix saying, I'll buy you for this. And they like, cool. Let us keep a little bit of this, and then we rock with y'all. Y'all pay this out. We make our shareholders happy, and we let Netflix pretty much take over. And we might have some on the. We might be able to get a board seat or something like that. A lot of times they try to negotiate some seats after they get taken over. But aside from that, excellent deal done for Warner Brothers, right? Even though the business is going bad. Now, the breakup fee, which was basically Netflix like, what if this don't work out? What if we don't get, approval or anything like that? Well, Warner Brothers like, if it don't work out and basically the DOJ says we can't get together, well, we'll pay you, I think $2 billion. I forget what the breakup fee was, $2.5 billion, something like that, right? And so Netflix, being the strategic people that they are, said, okay, that might be worth it, right? I was talking about it last year. I said, why did their exclusive agreement, why did they open it up for Paramount to do a bid? So Netflix said, hey, we're going to make it totally fair. Even though we have exclusive deal with Warner Brothers, we're going to allow Paramount they have 1 week to make a deal. Because I was saying, Netflix has the right to match it, right? So this might be smart by Netflix. They probably just want to see what the best deal is. They match it or whatever the case is, or they dip. So a lot of great things went into this. What I didn't think about is if they didn't get the deal, how was they going to get that breakup? This is $2 billion of cash that's going straight to Netflix at the end of the day, right? So it's actually a really great genius move on Netflix. And when you look at it, I don't know how good this is for Paramount on the short end version of it. So that's what they're talking about as far as the breakup fee. If it doesn't work out, they have a new breakup fee that Warner Brothers have with Paramount because now they feel like they're taking a bigger risk, basically, since they lost their great deal with Netflix.
That's worth noting. It's a termination fee that Paramount Skydance would have to pay if, for regulatory reasons, their deal was not approved. That's a $7 billion termination fee that would also be on the table should this deal not go through.
So now what's going to happen is they got to pay $7 billion if the deal doesn't go through. And I think that obviously Skydance feels very comfortable because of their relationship with the executive office, or their dads, as we should say. And so that's probably why they're okay with that happening. Okay, so we just saw those couple things play out.
Except that David Ellison was at the State of the Union, right, Julia? I mean,
well, that's...
I don't know.
Well, we have to note here that Sarandos was at the White House today. So
yeah,
you have to wonder what kinds of conversations Sarandos had with White House staffers.
Now, Sarandos is the co-CEO of Netflix, just for people who don't know.
That made him think maybe it wasn't worth fighting this or increasing
Absolutely.
their offer financially when they have these regulatory questions ahead.
Julia, thank you. Julia Borston. What does Netflix's path, Tom, look ahead now that it is free from this? What does it do?
Well, Netflix was on a great growth trajectory. It is far ahead of everybody else. Disney was number 2. Their streaming EBITDA is over 7 times what Disney's is. So they have a great growth trajectory. They didn't need $60 billion of debt and to be highly leveraged given those advantages. I really think the bigger issue for Netflix is how it's going to handle AI-generated content as it gets easier and easier for cheap but professional-looking content to gain viewership traction, and how does all the long-form programming that they're known for contend against that? And the fact that they don't have to make a $80 billion plus investment in Warner that would have been in long-form programming, how much does that free them up to really deal with what looks like the big competitive issues for traditional television ahead? So I think Netflix path is great going ahead.
So now that Netflix remains pure streaming, Tom, how does that sort of translate through to the rest of the sector? Does it make Disney look weaker, for instance, now that Netflix is free and is charting its course straight ahead?
I think Disney clearly was a winner during this process of other companies being bogged down, and they were probably rooting this would go on for a while and bog those companies down. Now that Netflix has been unleashed from those issues, I think Disney has its own issues in terms of how well it is able to drive viewership, engagement, and the advertising revenue it needs to drive that. Paramount is does have some antitrust issues. What you were saying before is true, I think, in terms of U.S. regulators and how the Trump White House might be viewing this. But let's not forget about European regulators. Let's not forget about the fact that they are consolidating 2 movie studios into one. They are taking 2 news organizations down to one. They are taking 2 streaming services and probably bringing it down to one. And all that has competitive issues that may create issues with European regulators. So that's part of the story is not over.
So a lot was said there, right? A lot was said there as far as regulation. A lot of times we forget, we have the DOJ here, but a lot of these companies are in the EU and they're in other areas. They still got to get through those regulators, which means that if they can't get approved there, then their content will be shut down over there. So tells you a lot, right? That's why you have like a lot of these companies, they have Disney Europe and stuff like that. Like they have the other aspects of their company in other countries because they have to follow those regulations and guidelines, right? So first is first. I'm going to talk about this whole deal and how it broke down and my thoughts from it and thoughts like this. Well, first thing is first, I'm a little bit upset. And the primary reason for that is I have bought a little bit of Netflix, guys. I did. I bought a little bit of Netflix when I told you I was doing it. And I was talking about the downward pressure on it, right? And so I brought it. I just bought a little bit. I was actually planning on buying more, but I like to do my buys over a time period and things like that. And unfortunately, not very happy. Now Netflix stock is shooting back up primarily because the downward pressure on the stock, right, is no longer the same amount of pressure that brought it down from like $130 where the pressure was. So I was like, oh, I'm gonna start buying it, and I was telling y'all about it. I was gonna buy more, and then of course the deal happened. The White House, everything happened so quickly, right? And I was like, damn. But I expect that I'll probably in the short term make a few thousand, right? And the good part about this, though, right, is I end up buying it in my Roth account, which means that all of the gains that I have will not be taxed, just the same. All right. So there will be no tax there for me. So, and I'm going to hold on to it because I believe the share prices will. I have to make a decision that do I want to buy more or do I just want to just take this? Because I really strategized for my downside risk where I was like, yeah, you know what? The downside risk where it is now is not very high. So it's actually the risk reward was really good for me. So I'm like, okay, I'll throw this in and then I'll throw this in here more. And of course, things happen fast, whatever. You take your wins and you dip. But this is in my Roth account. So it's going to go up more. I think the returns will be a little bit higher, probably 2-3 times even more, depending on how long I hold it. I'm not in a rush. But that's where I was standing on it, right? And so that's why I'm not going to like go through the whole account there because that's my Roth account. It's not the YouTube account. I'm just showing you that, right? And I was supposed to buy it in the YouTube account, but it, like I said, all that happened fast, happens in investing. If you don't overly go heavy up front, you pay for it. If you do go heavy up front, you pay for it. So it's a lot, right? So that's where I stand on that. So now I have a somewhat invested interest on Netflix continuing to outperform, which I ultimately think they can, but I will state some of the views and reasons why I'm thinking a certain way. First thing is first. Who won the actual battle? Paramount or Netflix? In the short term, I have to say, technically Paramount won. They beat them. They got the deal. Both people were going for the deal. Paramount won it, right? How do I think it will impact each business? Ideally, this is what I think. It gets harder and harder to produce great content. This is the biggest battle that in every industry. That's why all these streamers making so much money because they have the viewer's eyes, right? But when you get so big and you have such a wide library and you have so many users already. How many more users can you get? They're at 300 million. Is that right? Somebody looked it up for me. I want to say they're at 300 million subscribers for Netflix, somewhere around that, right? Do you think you can get 500 million? Do you think you can get 1 billion? You get what I'm saying? Like at some point you're like, we got 300 million users. All right, it's probably going to be hard to get to 600. So they have to find strategic ways to start increasing their revenues, right? Because as I told you, the higher you get, when you're making 40 billion, it's not easier to keep making that money. So you have to find other levers. You have to find other products. You have to keep doing this, and that. So I thought the strategy for Netflix was the licensing aspect that they experienced with Disney, where Disney licensed all their products to Netflix, and Netflix would have it on their platform, and Disney would get a recurring revenue source there. But they still own all their IP. Like Disney is really good at that. And so Netflix was like, dang, we can do that too. And it's a recurring revenue. And we need to do something like that to continue to increase our profits for our stock to continue to go well and our company to continue to grow. So that's what I thought their process was into it, because I was telling everybody, Netflix, you don't see people walking around with Netflix shirts on. You don't see kids with memorabilia from Netflix. You just don't see it. That's Disney's lane. They dominate that, right? Nobody is even close to them, right? Well, Netflix would have possibly started to get a little bit of a battle there because they are a more liked brand than Disney right now in the sense of like just adults and stuff like that. Kids gonna always pick Disney in my opinion, but they were gonna open their customer base by acquiring this deal. They were going to get the studio. A lot was going to happen there, right? And I think they're masters of execution, meaning they are the Amazon in this industry of execution. So I was like, oh, you give those assets to them, they may know exactly what to do with it and stuff like that, right? So I was looking at it in that perspective. I'm like, okay, they got the flush of cash of about $2 billion for the breakup fee. If they were to increase their offer $1 a share, you're talking about, I don't know, how many shares does Warner Brothers have outstanding? I don't know, 2 billion shares. So you got to give $2 billion more or $3 billion more. That's a lot of money. You can't just make that money appear out of nowhere. And I think that they realized this is an uphill battle, and the deal in which they struck, where they thought it was a good deal for them, where both sides were winning, it was starting to get further and further away from what made sense for them as a company. And so they backed out of it. Skydance or Paramount, on the other end, they are on the exact opposite, right? So what you saw happening with Skydance is something called a leveraged buyout, right? So those are LBOs, right? Essentially meaning they are going on to acquire a business, but most of it is levered. So they're using an insane amount of debt for acquisition. And the hopes of it is, dang, do you guys remember that show? I'm not a nerd. I'm not nerdy on you guys. I wish I was smart as them. Do you guys remember that show? God, what was the name of it? It's this guy. Man, he's an investor, and he goes in, he meets with business owners. They're usually in some type of distress. I don't know why I can't remember the name right now. And they usually strike up a deal, and what he does is he readjusts all their operations. He finds out where they're bleeding money at. He looks at the assets on hand. He looks at who is this little guy? I can't remember, but somebody in here might remember it. But it's the same concept. They're buying the business that they think is actually a good business, but they think a lot of the issues with the business is operational execution, something that they've mastered, something that Netflix has mastered. Skydance is under the leadership of Larry Ellison's son, etc. Right? So you have to realize that because of that, yeah, that's what it is, the profit. See, that's why I got y'all in here. See, I just need a few people that we talk about what we like to talk about. I don't need a million gazillion people. So this is essentially what Skydance is doing when they bought Paramount 6 months ago, and now they're acquiring. They're doing a bunch of leverage buyouts, and the whole backing of $60 billion and all that kind of stuff is just a backing. They're never going to actually have to put up to his assets for collateral. It's just a personal guarantee that he can afford to make because he's that rich. But we all know that they're not really going to have none of that at risk. So they acquired the assets. They're going to go to readjust operations. Now, they have to assess and say, we're better business strategists than the current management in place. And that happens. I actually believe that they are. I mean, Ellison's son is probably 40. He's really young. He's ambitious. He's making this buyout is a lot, though. Somebody look it up for me. I want to say this was $111 billion on the buyout. They got the breakup fee of $7 billion. They paid Netflix cash immediately. And I think that's one of the reasons Netflix left. They immediately dropped out because they said, we'll pay you right now. And that downward pressure on the stock allowed Netflix to shoot back up, and it's gonna consolidate over the next week or so at a little bit of a higher price. I think it's gonna probably hit $100. It might layer there for a while, and then I believe now Netflix is going to be strategically looking for a new business partner. Now, what other assets is on the market? I don't know, but they need something. They need something because they need to start keeping revenues increasing a certain amount to keep investors happy. So they need to acquire something similar to how Amazon acquired the James Bond franchise. They need to do something like that. They need to find something that starts to, add to their bottom line and help out, right? So Paramount on the other end, I think they're in a lot of trouble, in my opinion, because they're still heavily levered. It's a lot of debt, but these assets are extremely valuable. However, these are the same assets that were run by the current management that were not doing well. Let's just be honest. So it's not like they getting assets that didn't already exist. There was just a different management team. And so what are they going to be able to do that Warner Brothers isn't doing? You get what I'm saying? Like, and Warner Brothers been in this industry for a long time. It's very possible that you can get outdated, and management rely too heavily on nostalgia. They rely too heavily on their IP, and that probably is what occurred. They stopped having any ingenuity. They stopped being able to create. That is the advantage Netflix has. Because Netflix doesn't have any type of, nostalgic IP or anything like that, they are crazy on a little bit of ingenuity. That's why you see the streaming deals that they're doing with the WWE and the UFC and the deals that they got with the Logan Paul guy and all that. And they're always trying to find new ways. So they're more innovative in that aspect. But at some point, innovation gonna run out. If you make a flying car, what else can that flying car do? At some point, you're going to run out of ideas. And the industry is starting to consolidate, right? The streaming industry is not so super fresh now that Netflix has been dominated so long that they're going to start running out of ideas, and they need to find a way to print money. And that's where the residual income that is produced by your merch deals and things like that starts to make a lot of money. And you have to realize Netflix, for as great as they are, a lot of their franchises or a lot of their original content that they make is niche. It hit for a minute and then it dies down because you're only as good as your next hit, right? So the Squid Games thing is pretty cool. They made money off of that. I'm sure that they've made shirts with that and they made money off of that. But what's next? How are you going to make money 10, 15 years from that? So they have to figure out that strategy, right? Paramount, on the other end, heavily levered. I don't believe there's a pathway to profitability for them. I could see maybe them segregating the business, spinning off the linear assets and just keeping – because remember, Netflix just wanted the streaming aspect in the movie studios. They didn't want to touch the linear business because that's not core to what they do. And they don't specialize in that. Even though the linear business still produces good income, it's falling year and year after. It's a losing business that is actually still making money, if that makes sense. So Netflix, like, yeah, we good with that. The cool part about this for me is there's like a third competitor now. Paramount is a big deal. They're up there with the Disney and the Netflix, the Amazons, the Apples, and the stream wars. They're actually a big player now. To me, they're bigger than Amazon and Apple because Amazon and Apple rely heavily on original content, which is dope. That means they get new writers or whatever the case is, but they don't have that type of nostalgia with their brand for this type of industry. They're just figuring it out. So I think Paramount jumps past them and goes right behind Disney for third place. Netflix starts to feel a little bit of pressure. I think they go out and acquire something else, maybe something quietly, something smaller, something cheaper. But they got to figure that out. And to me, this leaves opportunity for Disney to copy strategies, right? At some point, maybe the linear business is going to get rolled out to a standalone business and no longer weigh on the balance sheet, right? That's a strategy that is always up for grabs. Disney doesn't like to do that. They like to keep all their business integrated. So that's going to be complicated, but it's an option based upon what we're seeing played out here, right? So I'm paying attention to all those things. But ultimately, to me, I believe that Netflix is the winner long term because I think Netflix is better at creating original content than any of the companies. The problem then becomes, how good is that original content, and can it compete with the Tom and Jerry's of the world? Because I'm gonna tell you right now, a lot of stuff ain't messing with no Tom and Jerry. A lot of people love Tom and Jerry, and they like a lot of adults now don't like this new crap that these kids got to watch. KG said the Game of Thrones can be a diverse fan. Yeah, that's a big deal. But how can they monetize that better than Warner Brothers was already doing it? You know what I mean? What special strategy that they got that, that Warner Brothers couldn't have thought of, has been in the industry for a lot longer. So I do believe that there's a lot of potential with Skydance. I do like their leadership better. Obviously, Warner Brothers suck, and they were destroying the business. They sold off a lot of the stuff that made them great, which is fine. You don't have to be in the industry forever, but we'll see. I feel pretty good about it in general, as far as positioning and, you know, how I can win either way. If Netflix continues to win, which I think they will, I'll participate in the upside. If Disney's ever able to, you know, get momentum running, which ultimately I believe they will be able to, we'll win there. And so there's a lot of winning aspects on the horizon for us. I just think that ultimately I think Netflix would have been the better company to go with, but they didn't want to pony up that money. And I actually respect that they stood down, because they could have made it go back and forth. They could have made the bidding war a little bit. So I kind of respect, hey, they took that $2 billion and ran, which is kind of smart. And now the pressure's off their stock. Now they got to go out and produce again. And the first thing they said is, we're already spending $20 billion on content. We're listen, they always say we're going to do some shares repurchase, which is obviously going to make their, like I said earlier, it's going to make your equity positions even stronger. But as I'm looking at it, to me, I don't want to say both groups won, but I would say Paramount needed this bad, and they were willing to pay almost any dollar amount to not lose, because I think Skydance, with their strategy, was, we have to win this. We need those assets, because they're in acquisition mode. And kudos to them. They found the price that they need. They were able to execute. They got the assets that they want. I want to see how they go out and make this any different. I don't necessarily believe that they will. I believe that operationally they might execute better. They might get rid of a certain department. They might integrate. They might bring their writers or the team that they have, put them in a room with the other people, and they don't want to mess up any legacy thing, right? And so does that mean HBO Max will be going away? No, HBO Max will not be going away. It's just controlled by a different parent company. This is common practice, by the way. This is industry norms. Companies getting bought out, mergers. It's very common. I think HBO Max was called something else before it was called. I think it's called Max now. They change the name all the time, so don't get caught up in that. That content's not going anywhere. It's just that money is going to be going to a new boss. But it's going to take a minute for this deal to close, by the way, guys. This isn't something that's going to happen in 6 months. There's going to be a lot of scrutiny on it. We don't know who's going to be in certain positions and all these type of things. So I think they projected at least like 12, 16 months for this to close. So a lot's going to be happening here. So we're going to keep our eyes on it. But ultimately, yeah, Paramount won. They have the connections in Washington, and they got the money to acquire the deal. So they got that. I just don't like leverage buyouts very much. I'm not going to lie. So I'm happy that Netflix kind of stayed lean. But, I wish Netflix would be able to get the deal. I wish they would. Netflix would have done great things with these assets. I just don't know what Paramount will do, but we'll see what this young, ambitious guy with his daddy's money is going to be able to accomplish. I wish I had my daddy's money. He ain't got no money, so therefore I ain't got my daddy's money. All right, I wish my dad was Larry Ellison. Shoot, I don't even think I would even want to buy no companies if my dad was that rich. I don't want to do it. I don't want to do no. Would I want to do all this work? $150 billion. I don't know if I want to do all that. He says Paramount just didn't want Netflix to have it. Sure. I actually no. I genuinely don't believe that's the case. I think they for their company to continue to ascend, they needed these assets. Well, if somebody go look it up for me. What was Paramount's revenue last year? Somebody look that up for me. I don't think they're making anywhere near. I don't think that they do make money though, but I don't think they're generating the kind of money to compete with Netflix with a margin difference, right? I think I think they owned some assets before, but the margin difference with Netflix business compared to theirs is night and day. Like Netflix, their standard for margins is the same. It is the premier company when it comes to that. So yeah, so KG said they made 29 billion. Yeah. Now, do me a favor, KG. You see their revenue. See if you can pull up the net. I see what they generated. How much of that money are they able to retain after they have to disperse all their payments, right? Because that is the real, we really want to see that real money, right? And what they actually can do with that cash flow there. I'm going to guess it is not substantial. I'm going to guess. Now, if they are producing $9 billion free cash flow, you know what? I might have to just tip my hat to them. Yeah. Okay. Now, there we go. That look a little bit right. $3 billion for the year. You make $3 billion a year. You just paid Netflix $2.5 billion for the breakup fee. So you got $500,000 of cash. And I'm being facetious right now, but I'm just saying. It's a heavy on capital intensive business that they're in, right? To produce a film, I might have to pay, I don't know, Tom Cruise $40 million to do this film. I may have to pay Tom Cruise $40 million to do this film. For me to really, really run it up, that film has to do so insanely well. I mean, we're talking, I probably need to do 800 to $1 billion at the box office, probably 1.5 on the high end on a good day. I need to be able to make merch off the movie and sell those shirts. Like, I got to really make that money work because I got to pay a lot of producers. I got to pay for this. Like, I got to do a lot. I got to create the set, got to get the script right. Like, it's a lot of money. It's very capital intensive for that type of industry. It's not like technology where overhead cost is like super controllable, right? And where that's why tech is just dominates so much right now, because they don't have to occupy a building. Like, it's just so different. So he said they lost money last year. That's why I was surprised. No, that like I said, it's a levered buyout. You shouldn't be surprised. So if you have the assets, and mind you, the levered buyout, they are putting a value on the potential acquired assets. So not the assets that currently you have. They're looking at the assets that you're going to acquire, right? And they're like, oh, so you about to acquire Warner Brothers? That's some good. We had our people look at that. That's some good. That's some good. We willing to give y'all a loan for that because we believe we'll get our money back. So ultimately, that's what I think occurred. And I think which banks? I think Bank of America was one of the underwriters on this deal. I forget there were two other banks that I forget come to mind, but I remember B of A popped up. All right, Robert, thank you. So overall, man, I'm eager to watch it play out a little bit more. I just personally believe Netflix have to do something. They can't just take this L and walk out the building. They have to be able to pivot, and they have to create some more revenue somewhere. Because they didn't strike this deal out of nowhere. If you're studying, you like, yeah, they know that they're going to struggle with top end money soon. They know. See, what happens is the customer is very fickle, right? You have to find that balance of how much to charge them and how much your content is actually worth to them, and how to keep their eyes, right? Right now, everybody's buying, man, I got Netflix, I got Disney, I got Hulu. Everybody's comfortable with having so many streamers, right? But at some point, there's a level of consolidation that needs to occur, because that allows you to have, for corporations, the most price control. The less options for people to go and utilize, the more pricing control you have. But at the same time, there's only so much you can yaks the consumer before they will go to a competitor for less money, right? And so Netflix eventually has to say, we need to find a way to not raise the price is so much on our consumer and make sure we have the content available for them to consume. And I think that that's where they're struggling at. So ultimately, hopefully they figure it out, but we'll see. I am concerned as a long-term investor. I think the business is fine, but I don't believe it's the domination that it once had over everybody else. I don't see if they can continue to do that. If they strike a deal with like a special streamer or something like that, then all right, they may continue to run it up, but they need to find something, right? That's one of the reasons why I'm a little more comfortable with Disney, because not only because they have the IP, but because they have another revenue generator, which is the parks. And I don't really care for the cruises, but that's starting to become a pretty profitable business for them. But those parks are like, it just churns money out. And so that money can go to reinvest in the streaming business, etc. So I like when you have other levers you can pull on to generate money. So that's part of my thinking in there. But we'll see. We'll see. Anyway, guys, hope you guys enjoy the show. Gots to go. See y'all next week for the next show. And like I said, until next time, we gone.